Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Victor Adair, co-founder of the Polar Futures Group. He's Senior Vice President and Derivatives Portfolio Manager at PI Financial in Vancouver. His website, PolarFuturesGroup.com. Welcome back to the show, Victor.
Well, thank you, Jim.
Well, before we get into what's going on the markets, let's take a look at the global macro environment. The big story seems to be that economic growth is slowing right around the planet, and the central banks are now adjusting their activities accordingly. Do you agree with them putting the brakes on interest rate hikes?
Well, I think that it really is the big story, is that we've had, call it 10 years of rather sluggish economic expansion in the major developed countries, and that came as a result of, massive monetary accommodation from the different central banks. And even with all of that, it seemed as though here as we were going into the last fall that economies around the world were starting to slow. Certainly, we go back maybe just the past few months when the Fed, which is basically the leading central bank in the world, really started to give some indications that they were going to slow the policy that they'd been on, which was euphemistically called quantitative tightening, as they were selling back some of the securities that they'd bought into the market and raising interest rates, that they were going to slow down that program. And then we've seen other central banks as well, say move from a hawkish or slightly hawkish stance, where they'd been raising interest rates, to maybe signaling to the market that they're going to just take it easy here for a while as they're looking around the globe, seeing, and the language is always they're seeing different things that concern them when they speak to the public or the press. And yes, that's the major story. And of course, since we had the lows in the stock market in Christmas time, the stock markets around the world basically have had a good strong rally, and certainly part of that has been this change in tone from the central banks.
Well, they just did a study, and seniors, people 65 plus, are leading defaults on their payments in Canada. Is that an indication that interest rates already are too high?
That's a good question, Jim. I think there's been some thought, and I would say at the forefront of the people that are speaking about this, David Rosenberg, Canadian economist in Toronto, and he's been taking the view that the Fed historically tightens right into a recession. And again, as I said, the Fed, the main central bank of the world. So, yeah, the Bank of Canada, had 3 interest rate hikes, and maybe that pushed us too far. That's often the case, and that the central banks will tighten right to the point where, oh my gosh, we've gone too far, and they'll start to backpedal.
Well, a large chunk of the Canadian population said in a survey that they were just $200 away from going into the hole. So you could see why even just a minor interest rate hike on their mortgage could be damaging or disastrous.
That's right. I could see that.
In some of your previous interviews with us, you've said the leading American stock indices have been a bellwether for risk sentiment. Do you still think that's the case? And if so, what are those markets telling you now?
Yeah, I think if you wanted to judge whether or not the markets around the world were in a risk-on frame of mind, you don't need to look any further than the major American stock indices. And we're up 9 or 10 weeks in those different indices from the lows back at Christmas time. It's clearly an indication that the market has been more inclined to take risk, whether it's in stocks or in commodities or in credit markets or what have you. or even in the currency market, certainly. And but we've been seeing some signs here. I think that maybe the last week or two that sentiment's getting a little long in the tooth, that bullish sentiment. We've seen, for instance, the transport index, the small caps, also weaker the past couple of weeks. Not to mention, what's happened here the last couple of days, where prices are falling back from their highs. We had a terrific bounce back here the last 10 weeks or so from the hole we got in at Christmas time, and it's beginning to look like maybe the run to the upside is running out of steam. The markets interpreted most anything that came along as positive, certainly the activities of the central banks, but, just looking at say that the U.S.-China trade negotiations, every time somebody says, oh, things are going along pretty good, that's, oh, good. Well, we can tack on another 200 points on the Dow. We've also seen, by the way, another barometer I watch, the levels of volatility, like the implied volatility in the stock market options, were at a very low level October of last year. They went up substantially as the stock market fell, and then since Christmas time, as the stock market has rallied, we've seen volatility collapse right back to about the lows that it had in October of last year. I'll note the Toronto stock market, I was looking at this the other day. It's had a terrific rally off of the Christmas lows, and I'm thinking the Toronto market might catch down a little bit to the to the levels that we've seen with the American market that have backed off here the last couple of weeks. And overall, I look at what I call the psychology. Psychology was very scared, very bearish at the Christmas lows. It's got much more bullish here as the rally's gone along. And, we'll see what happens from here. But, I think we've had a run. It looks like we could back the market up here a bit. We'll see how far it goes.
We'll have more with Victor Adair right after this.
Hi, I'm Douglas Mason, President and CEO of Rainy Mountain Royalty Corp., RMO, on the TSX Venture Exchange. Rainy Mountain Royalty Corp. is a Canadian-based mineral exploration project generator. The company currently holds multiple property interests in Ontario with joint venture partners and is seeking further joint venture partners for other drill-ready properties in our portfolio. For more information, please visit our website at rmroyalty.com or call me at 604-922-2030.
Cypress Development Corp's flagship lithium project is located just east of Albemarle's Silver Peak mine in the heart of Clayton Valley, Nevada. A 12-hole exploration drill program for lithium-enriched claystone on Cypress's 100% controlled properties is now underway. Cypress Development Corp trades on the TSX Venture Exchange, symbol CYP, the Pink CYDVF, and on Frankfurt's C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
Welcome back. We're speaking with Victor Adair. Victor, you've always been very focused on the currency markets, and in our previous interviews, you've generally been bullish on the U.S. dollar. What are your thoughts on that now?
Yeah, I definitely remain bullish of the U.S. dollar. Maybe actually, just before I go to that, I just thought of something about what we were just saying before we took the break. In a where's the risk now? I mean, I think the risk generally is, if you are in things that have had a big run-up, you should probably take some money off the table, take some defensive action, what have you. But let's say, for instance, in a low interest rate environment like we've been in, investors are likely to start lending money to increasingly risky borrowers. So I'm focused there on corporate debt. We've got a lot of corporate borrowing out there. A lot of it looks like it would be shaky if things get a little worse. Then there's like the high flying stocks. Last summer it was what we called the FANGs, the tech stocks were really spoken to the upside, and they fell pretty hard when we had that tumble into the Christmas lows. Lately there's one stock that's just really amazing, and that's Boeing, the aircraft manufacturer. I mean, it's an incredible company, a great story. But the stock is up 50% from the Christmas lows in 3 months. I mean, that's a heck of a move. If you were loaded up on the, to the gills on Boeing, you probably want to get a little cautious or that sort of thing. To come back to the U.S. dollar, yeah, I mean, we're just touching now the best levels we've seen on the U.S. dollar index in 20 months. It is really up today against the euro currency as the European Central Bank has signaled to the market that they're worried about the soft economy over there. They're going to start restart their program of lending money to the banks to try to stimulate the economy. I've said for years that there's really two reasons that capital comes to the United States, and that is for safety and for opportunity. So, I mean, we had a time, let's say in the late 1990s, when the dot-com boom was centered in America, and capital flooded to America, drove up the U.S. dollar, people looking for opportunity. And then there's other times, certainly, like, let's say now, we see this past week, the stock market's starting to look shaky, and the U.S. dollar gets bid. That is, let's say, people looking for safety and opting for the U.S. dollar. So I remain generally bullish of the U.S. dollar, and those are my reasons.
The Canadian dollar has dropped the last couple of weeks. Is that the result of the SNC-Lavalin issues playing out, or are there other factors weighing in on the loonie?
Yeah, certainly there are other factors, but, you know, the political shenanigans that we're seeing out of Ottawa aren't doing the Canadian dollar any favor. I mean, that's for sure. But, you know, back 2011, 2012, thereabout, Canadian dollar was trading at a premium to the U.S. dollar. You know, now we're around 75 cents. What's happened since then? You know, Jim, we talked on the show before that there's some major inputs or correlations that the Canadian dollar has, and that is, for instance, it'll go up and down to some degree with the stock market. It'll certainly go up or down to some degree with commodities, especially the crude oil market. Interest rate spreads. I mean, right now, we've got the spread, in other words, the premium that you get for having your money in 2-year government paper in the United States is 80 basis points more than you have in Canada. That spread, that's at least 12 years wide, or it hasn't been that wide in at least 12 years. So there's a real draw for capital to go into the United States when interest rates are so much higher down there. The floating dollar that we have, instead of, let's say, fixing the U.S. dollar to a level against the American dollar, the floating dollar we have is a benefit for us in terms of call it a shock absorber. Our economy is struggling relative to the U.S. economy. If our currency wasn't floating, and let's say it was fixed at par to the U.S., you know, maybe we'd have unemployment at 15% or something. So, you know, there's pluses and minuses to having the dollar move, but, you know, it's down here, I think, because the U.S. dollar is strong, and because the interest rates, premium is such an attraction, or such a draw for the U.S. dollar.
Now, of course, we focus on comparing the Canadian dollar to the U.S. dollar. How is the Canuck buck doing against other world currencies?
Fair question. I mean, I couldn't tell you at the drop of a hat here. The Canada is generally going to be trading opposite the U.S. dollar. So if the U.S. dollar is doing better against most currencies, it's also going to be doing better against the Canadian dollar. So in that kind of an environment, the U.S. dollar is up, then all other currencies are down, Canada's down, the euro's down, and so on. Right now, the only currency up today, for instance, of all of the currencies that I look at, is the Japanese yen, and it's only up a tad, and that is because the Japanese market gets a bit of a risk premium bid when the U.S. Stock market is soft.
We'll have more with Victor Adair when we return.
Arctic Star Exploration, operated by a team of proven mine finders, is focused on diamonds in Finland and the Northwest Territories of Canada. Work programs are underway in Finland and Canada. Arctic Star trades on the TSX Venture Exchange symbol ADD, on Frankfurt symbol 82A1, and the OTCQB symbol ASDZF. Please visit our website arcticstar.ca or call us at 604-689-1799.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're chatting with Victor Adair. Vic, at the end of January, you told us that easier monetary policies from the central banks was one of the key reasons gold was rallying. Gold hit a 10-month high in mid-February, but has dropped about $60 since then. Why the sudden drop?
Well, you're right. The gold, and I did say that in January, and it's probably one of the most bullish factors for gold is when the gold market sniffs out, as I think it did beginning back even in October and November, that central banks were going to back away from their hawkish policies and become more, let's say, more friendly or more dovish. That is one of the single most bullish factors for gold. Now, you go back to last summer, gold was really out of favor. I mean, the stock markets in the United States in particular were trading at new all-time highs. You know, who needs gold in that kind of an environment? And we saw on the COMEX, the paper gold futures market, for the first time in 10 years that speculators were actually net short of gold. That's how much it was out of favor. And then as the gold market started the rally through the fall, I think a good part of that was sensing the change of policy from the central banks, but also gold was seen as a safe haven in an environment where stocks were looking risky. And we had the gold market then carry on, as you say, made a high in February, fell back from there, and I think a couple of things contributed to that. Certainly, since the mid-February period, the U.S. dollar has become stronger. Real interest rates have been higher, and those are two major headwinds for the gold price. And I think gold probably ran up too far, too fast. You know, from being a net negative position in last summer, speculators came stampeding into the gold market, and then as it fell back, you know, they got positions that are underwater. People are selling off their positions. At the high in mid-February, the bullish sentiment on gold was at 90%. And for me, that's like a red flag being waved at a bull. You know, that market got too high, too fast. We backed off. Now, where we go from here always depends on your time frame. But in an environment where the central banks are concerned that economies are slowing and they're going to, throw coals on the fire, as it were, to try to stimulate things, that's a positive environment for gold. But that same environment is usually U.S. dollar friendly. So you might say the best we could hope for would be gold going to be going up against other currencies other than the U.S. dollar. And in a perfect world for gold, it goes up against all currencies.
In some of our previous interviews, you talked about how the price of crude had a high correlation with the ups and downs of the American stock market. If you're now skeptical of stocks, does that mean you think West Texas prices could fall?
Yes, there has been a really interesting correlation between stocks and the price of crude. For instance, I mean, crude oil was making a 4-year high or thereabouts in October of last year as the U.S. stock market, the major indices were trading at all-time highs, and then they both rolled over and sort of simultaneously fell into the Christmas lows, and they both bounced from the Christmas lows to where they are now. Crude's very much a supply-demand story, but I think the market's assumptions about supply is much more important right now than demand. In other words, you were seeing signs of a slowing global economy, and you'd think maybe that would be worrisome for the market, that, that people are going to be using less petroleum products and therefore the price would fall. But the market seems to be much more fixated on the supply side. So when we see OPEC and friends, whatever, say that they're cutting production, and that's what the reports are showing, that seems to have more of an impact on the price of crude than the worries that maybe the world is going to demand less crude because, the economies are slow. However, if we did see the stock market fall here over the next couple of months, I would really expect that the crude oil market would track down with the stock market.
Victor, you've been trading now over the last 40 years. Can you give us some ideas using that experience on how people can become more successful traders? Well,
I hope so. Let's see. I'd say certainly, we're going to have to be a little bit general here instead of being specific, but I've met over my career in this business, I've met some really successful traders, and they're as different from one another as chalk and cheese. But each one of those guys, and it was always guys, I'm sorry to say, just found a way to participate in the market that suited their personality, suited who they are. I mean, I know of my personality. I like to say, I like to call something where, market's had a terrific run, and I think, okay, it's gone too far, too fast. I want to look for a spot to sell it. Same if the market's gone down too far, I'm inclined to want to buy a market like that. So you need to, the old adage, you need to know yourself, and in knowing yourself, find a way as to how you're going to participate in the market. One of the things I think I've said on this show before that I think is absolutely critical, and that's to keep the time frame of your analysis in sync with the time frame of your trading, and vice versa. So if you've got an opinion that that the crude oil market's going to rally over the next couple of years, and you take a position in the market and it goes against you tomorrow and you pull the plug on it, it's like, well, what was that all about? If you're taking that 2-year forward view on crude, then the position that you put on ought to be in sync with that. So if the market drops the next day or two or whatever, that's not a problem for you. Okay, one other thing here that's, I think, really important, and that is to have what I call a contingency plan, and to have that plan before you put on a trade. In other words, what are you going to do if you're right on your trade? What are you going to do if you're wrong? And I think it's actually way more important to know what you're going to do if you're wrong. You buy a market and it's going down. Well, what are you going to do? Just stand there and yell at the market, say everybody else is an idiot and you're a genius? At some point you need to say, I'm wrong. Nothing wrong with being wrong except staying wrong, I like to say, so you want to step out of it. On the other hand, if you bought into a market and by gosh, your analysis is spot on, market is rallying, should you be adding to your position? Should you be raising your stop? Should you be writing some calls against it? Whatever. What is your plan? You're trying to make money. At least that should be your plan, rather than to, just try to prove that you're the brightest guy in the world. And one other thing, Jim, let me leave you with this. I like to look at relationships or spreads. For instance, I want to look at, say, what the price of wheat is relative to the price of corn. I want to look at what the relationship is of 12-month forward crude relative to the spot market. Those sort of things. I want to say, what's the Canadian dollar trading at in terms of Japanese yen? And then ask yourself, why is that? Why is that happening in the market? And if you do that, that's like doing your homework, as it were, you'll understand markets better, and you'll probably find some trades that you would never have found otherwise.
Victor, thank you so much for being on the show.
Well, Tim, it's always a pleasure to talk with you. Thank you kindly for calling me up.
My guest has been Victor Adair, co-founder of the Polar Futures Group. His website, polarfuturesgroup.com. You're listening to HowStreet.com radio. Find us on Twitter at HowStreet. If you have any questions for Victor or any of our other guests, you can send them to info@HowStreet.com. Check us out on YouTube at Talk Digital Network. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.